G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and we bring in some awesome guests. Today is a name that's synonymous in finance, cuts across a number of parts in property education, ETFs, for example. Owen Rask, welcome to the show.
Thanks, mate. It's great to be here.
I really appreciate your time, mate. And for those that are unfamiliar, Owen Rask, I'd say you're probably living under a rock because you've probably heard him across quite a few different podcasts. I'm just going to read these out. So Australian Investors Podcast, Australian Finance Podcast, Australian Business Podcast, Australian Property Podcast as well. On top of that, I mean, you're ranked in the top 5, mate. And what are we talking? Like triple figures, 250,000 listeners per month, mate. You've got to be doing something right here.
Well, we try, mate.
You did more than try, mate. And that's why we want to get you on here, because obviously you're cutting across a number of different disciplines in property and finance, for example. So you've got some nuggets there to share. But your own personal journey, I think, says a lot about kind of where you've come from and what you're looking to do in the future, which we want to have a chat to you about. And I love when I've gone through your education site and what you're looking to do there as well. It's very, very clear. There's no agenda. It's knowledge is power. Power is then going to make the change to make action happen and people make some decisions as well. And we'll talk through, I guess, that cascading effect that you're having on people's lives and what you're looking to do, because this what do they call a big, hairy and audacious goal, for example, of taking your community from, say, 27,000 to 100,000. That means you've got to be having some level of impact on people. I mean, when you reflect and you go, you started with 0 and now you're impacting that many people. Is it a pinch me moment? Is it kind of, this is what we always intended to do? How do you take that in?
Yeah, it's pretty funny. I think in any business owner's journey, you start off and you evolve with it. And of course, every day I'm very grateful for what I get to do. But I think the thing that when I started out, I remember when we first started creating financial education videos, and we didn't really have a business model. We were just creating financial education, like literally just animated videos, like walkthrough videos, that type of thing. And I was calculating the views, like I was like adding them up each day on YouTube and whatever. And now it's got to a point where I no longer count views. We count like much bigger metrics and much, I guess, more nuanced metrics, because we've kind of evolved as a business. And I think there's nothing, like, as much as I nowadays spend most of my time looking at the data and the bigger picture, there's nothing better than just chatting to someone. Like if someone comes up and says, "G'day, I was just at there's a random occurrence that happened recently. I was just sitting at breakfast, and I'd mentioned this cafe on the podcast a few times, and I was just having breakfast before work, and a guy that listens to the podcast who I'd never met came in and just had breakfast with me. And we just sat there for about 45 minutes, and there's nothing better than just meeting people and just seeing that impact that you have on their life. And I mean, I know that's what you do so much of as well. And I got to admit, like we get to work wonderful jobs, and the kind of the byproduct is that we get to positively impact people's lives, which I think if anyone can get themselves in a role like that, just count your blessings, because it is truly wonderful.
Mate, well said. And these type of mediums is, people self-select, for example, what they're going to listen to and when they listen to it. So you and I don't get really much visibility into who our listenership is until they actually come out of the woodwork. And then they've been, I've been listening to you for quite some time, and you're like, wow, now you've decided to reach out. They come up to meet you in person, and you're like, this is pretty cool. Like this obviously means we're having that, and I keep talking about the ripple effect, having a massive ripple effect on people's lives and effectively, their network as well.
Yeah, absolutely. And I think like what you're referring to is kind of like unique to what we do, both in the podcast medium, but also in the online medium, in that a lot of the times you just see numbers that come across the screen, like you've got listeners, you've got viewers, and it's not really until you talk to someone over the phone or you have a conversation that you get to really appreciate the impact that you have. And I think for me personally, like COVID had a big impact in that way, because we couldn't do our physical events. And it basically meant that it was wonderful for our business, like 2 or 3x in 2 years or something. But the downside is that we couldn't connect with people. And then we did our roadshow last year, and we had about 1,200 people come along. And it was just so good to meet people in person. Like it was just totally refreshing and recharging. Like I'd come away from an event and I'd just be on this high, because we got so many people in the room and they all just wanted to just connect. And that's something that we do miss when we just sit behind like this microphone or a camera. And so I think that's just a wonderful thing. And I don't think that feeling necessarily has to be unique to what you and I do. I think that it can come from anyone that listens to this podcast. If you have an impact on people's life, you're going to put yourself in a great situation where you feel good about getting up every day and going to work. And I remember listening to a podcast or an interview, I think it was, with Oprah Winfrey, and this is going back quite a few years. And she said, just be remarkable, like just literally just be remarkable. And when people hear that, you're thinking of like some cyclist that does the Tour de France, or someone that goes around the world in a solo yacht or something like this. But being remarkable to me just means that people remark after you, meaning that they just talk about you when you're not in the room. And if they say good things about you, I think that's job done. And so I think like for us, like we do the podcast where we get people to listen to us. But anyone can do this and anyone can have an impact. And that's just the way I think about like going through life and compounding.
Yeah, lovely, mate. Love the sentiment. Thank you very much. And you're right, the barriers to entry are fairly low. Grab a microphone and camera and away you go. You got open access to everyone. It's a bit like mortgage broking, right? Do a Cert 4 or diploma and get a computer and away you go. And I think there's sometimes the low barriers to entry, but then you're right, where the people really set themselves apart is where they're having that deep impact. For example, it's not vanity metrics that people are measuring. They're going, how much impact am I having on people's lives, and getting that feedback loop that, hey, look, that resonated with me. I'm now taking some action. And you're going, right, clearly we're striking a chord here.
Yeah, absolutely.
Perfect. So a little bit about yourself, personally, professionally, your own journey in life, mate, in a nutshell.
Yeah, sure. I'll give you the short version. People have probably heard this before.
Yeah.
So I started out, I grew up in a farm, on a farm in Yarra Valley in the outer eastern side of Victoria. And I kind of got the tough love idea, pretty early, that if you're gonna do something, you have to work hard. And I saw my parents do that. I also went through a period where my parents, split up, and that was a pretty messy thing, and it took a long time, and that left a really big impact on both me and my brother. And we didn't come from families that had money. We didn't come from families that went to school, all these different types of things. So we kind of knew in our bones that we needed to work hard. But I took that and I finished my schooling, and I thought, I don't just need to work hard. I also need to work smart. And I think that's something that is probably lost. Like oftentimes we teach our kids to be, hard workers, and if you save money, you will do well. If we just think about the frame of money, and I think that's actually a mistake when we think about that, because there's so much that people can do, and young people can do in particular nowadays, that doesn't require you to work hard. It just requires you to work smart. But if you can combine the two together, you're going to be placed like exceptionally well. And so out of school, I discovered kind of like, it took me a while to figure out what my passions were. And I realized that just I wanted to help people. And, I spent some time, this is how bizarre my kind of career paths went while I was studying. I ended up working at Melbourne Zoo for a while, and just being around all the animals, which I loved, and all that sort of thing. And then I also spent some time. I got accepted into the Special Forces Direct Recruitment Scheme, and then I came back and I studied economics. Then I studied technology because I could see where those two things were going. And yeah, I ended up at this wonderful company called the Motley Fool. And I took what I learned there. They say that the first job that you have out of school leaves the biggest impression on you. And I think that can be said of many things, not just work, but also relationships that you have and so on. And for me, I learned, and I was very blessed to learn a lot from those guys at the Motley Fool and gals. And I took that and I basically rolled that into what became Rask. So Rask started in 2017, and it was set up just to provide education, because I had the economics and the financial knowledge, like financial planning. I did my mortgage broking as well over one summer. Never actually practiced as a mortgage broker, but I did all those things and accumulated a lot of knowledge really quickly. And I thought, well, if people are going to take me seriously, I need to be able to tick off all those boxes. And so I did that in my early 20s. And I ended up, launching Rask in 2017 with a view that we can provide pure financial education, because I would look around and I'd go to like the Combank website, you click on the tab and it would say education. And what most businesses mean when they say education in finance is they mean education about their products that they sell you. So in other words, marketing, basically. And so I wasn't particularly happy with that, because that's not how I defined education. For me, it was something that, probably should be as unbiased as possible and can help people grow and learn and make informed decisions. And so I set about trying to change that. The original business model, as I mentioned before, didn't work. So we moved into subscriptions, and that's how we monetized our business for a very long time. And now we're big enough that we can monetize through ads. And so, yeah, that's the short version. But there's probably a lot to go on there, and I apologize if I lost you, but
Not at all.
that's basically where we are today. We're a big education investment management platform.
I love it. You mentioned there before around like there's a very fine line between education and quote unquote marketing. And it's a question that I had for you. How does someone decipher the difference between the two? How do they know that they are the product versus someone has a product?
Yeah, I was thinking about this because I was thinking about the role that you mentioned before, a mortgage broker.
Yeah.
You can get the barriers to entry are pretty low, right?
Yeah.
I think you would know if you came across a really good mortgage broker versus if you came across someone who genuinely cared. Um, and I think for most people, you could tell because the mortgage broker would go above and beyond to educate you and maybe help you avoid some risks, maybe actually take into account what kind of asset you're looking at buying, maybe provide some feedback there, and not necessarily just treat it like a transaction. And I think that's what you often get when you try and get into those quote unquote education, I guess, pages and resources, is you often find that it's actually just one big thing that's just trying to tell you how great their product is and move on, kind of thing. I think that for me, when I thought about this, like we obviously monetize our business through advertising on our podcasts. We have subscriptions and these types of things. We also run events that are basically, well, anyone that's run events knows that they're very rarely profitable. So we don't run it at a profit.
And, yeah, great.
But basically, what we do with our education side is we keep that free from any type of commercial, like I guess, intent. So we may invite like financial planners on there, and I'm sure that's great for their, good
profile.
juju. It also gives them some brownie points and whatever. But there's never any kind of like upsell or anything like that. So we try and keep that as pure as we can and answer as many questions as we can and just be as helpful as we can. Like one of the things that we can see is that sometimes people don't always finish courses and we have to ask ourselves why. And we've got to make them better in terms of giving people actionable things to do. But at the same time, I think that we often fall afoul in finance in that we often just want to give people the answer. Like we want to give them advice and not really sit there beside them and go the extra distance to educate them on all the other things they might need to know, because it's not as profitable for us. Where we've tried to break it up, like you mentioned the 4 different podcasts before. That is because we know not everyone is interested in everything, but we do try and cross promote the podcast channels so that people who are interested in property or are interested in business will also learn about ETFs, or will also learn about budgeting and these types of things, because we do believe that that's the best type of education, is like not just being focused solely on one thing and saying that this is the solution that you need, because I guess to the carpenter everything's a nail kind of thing. We want to make sure that we give everyone the best possible insights.
I love it. Thank you very much. Appreciate that. And you're well known for ETF investments. So, I mean, we predominantly talk to property investors, for example, but, there's a golden rule. You don't put all your eggs in one basket as well. So to the uninitiated, take us through ETFs 101, what they need to know about.
Sure, mate. Yeah, so you just said basket, so I'll run with that analogy. So an ETF is just a basket, and most people know them as a basket of shares. So if you were to go into your brokerage account, like say you use one of the big broking platforms, you click on Commonwealth Bank shares and you click buy, you get Commonwealth Bank shares. You get one share, which is Commonwealth Bank, and you own part of Commonwealth Bank. Now with an ETF, what you get is effectively a basket. So the most popular ETF, not to be confused with FPOS or EFT, it's ETF, is the Vanguard Australian Shares Index Fund ETF. So that's a mouthful. Basically, it's from Vanguard and it invests in Australian shares, and inside of it, it has 300 shares. And this is the most popular ETF in Australia by the total investment amount. And basically, it's one of the first that started. It's also pretty low cost. I'm not promoting it, no affiliation with Vanguard, but it just illustrates the point that with one investment in that ETF, you can actually get exposure to 300 different shares, as opposed to picking Commonwealth Bank by itself. You can just buy an ETF and you can get CommBank inside that, but also 299 other shares. And there are many different providers in Australia that are really well established: Beta Shares, GlobalX, iShares, State Street. The list goes on. But basically, what ETFs have done for the investments industry is it's basically meant that people don't have to pick individual stocks, and they don't have to do quote unquote trading anymore. They can literally just go into a brokerage account and pick, 5 really popular ETFs from different types of investments, and that's a diversified portfolio. So if you've ever read a book from like Tony Robbins, or clicked on a video from Ray Dalio or something like this, and you've seen an all-weather portfolio or a diversified portfolio, you used to have to go and buy each of the individual investments, but now with an ETF, you can just effectively get all of them pretty quickly. And ETFs aren't just for shares, by the way. So people think that they are just for the stock market. There's an ETF for property securities. It owns like Metricon, Center Group, the shopping centers. So there's an ETF for basically everything these days, and that's what makes it really easy to invest. And we saw this, to answer like how we got involved in this. Through many different turns of my life, I actually worked at a really highly regarded investment firm, research firm here in Australia. And as a junior analyst, probably the most junior analyst, I was assigned to cover all of the ETFs when they were kind of just starting. And I was like, what? I was that classic WTF is an ETF. Like, that's what I was thinking. And I was like, what is this? And finally figured it out. And then I realized that, hold on a second, this is going to make it so much easier for people to invest. And so that's why we've built our business around this trend. And we've been following ETFs for probably 10 years now. And that's what we've become known for. And it's been wonderful. So it's helped a lot of people invest that would otherwise be put off.
Yeah. And that's what you mean, put off. I guess because the barriers to entry, when we look at different asset classes, for example, so property, for example, high barrier to entry, stamp duty, maybe a buyer's agent, additional cost, for example, and deposit is a real barrier to entry versus crypto ETFs. Is this why we see like the younger generation come in because they're obviously cash strapped or limited, or just going to look from a risk perspective? It just helps me dip my toe in the water as well. What are you seeing from your community?
Yeah, for sure. I mean, I think, properties are a wonderful thing, Aaron. You know this because you've been doing it for so long, is that properties actually, it can be quite intimidating for people from the outside, I think, because they do see the high barriers to entry, but once you're in the system and you understand it, the high barriers to entry are actually your advantage. And so I think there's like a spectrum of like, crypto is really easy to buy, but that does not necessarily mean good. And property's more difficult to buy and sell, but that can actually be really good because it avoids you from, like, imagine if, you could buy a property today and sell it tomorrow for a 0.1% gain, right? There was no frictional cost. There was no stamp duty. There's no nothing. You'd probably, like, maybe not you, but like someone listening to this might be like, okay, I'm going to buy and sell 500 properties in the next week and see if I can make some money. And we know that that's not how it works. And so what's happened with financial apps and these types of things is they've made it so easy for some of those biases, which I know we want to talk about. It allows them to kick in, to overdrive, and you can shorten your attention span to a very, very, like, you can do it down to the minute, or down to the second on some platforms. And I think that's actually, one, really unhealthy, but two, it's actually not going to work. ETFs kind of have this spot where you still need to open a brokerage account. Most of the time, you still need $500 to get started. And so that kind of keeps out like the really small micro amounts, but it gives you a good entry point and it's enough for people to take seriously. But what we've actually found in our community, which is quite odd, not odd, it's actually I actually like it and it suits me perfectly fine and the business perfectly fine, is because we have, I think it's 10 or 11 different podcast hosts now, and basically all of them come with 10 or 20 years experience in their respective discipline. And what we've actually found at Rask is that we've attracted a much older audience, and it's probably most common with some podcasts. And some of the people that they kind of bucket us in with tend to have audiences that are in their 20s. We have more people listening in their 70s than in their 20s. Which was bizarre to me when we did our big surveys and all these types of things. Like that really caught me off guard. But I guess what we've found is that people in their 40s and 50s and into their 60s are really, really open to ETFs. Most of the time, it's because they've had really bad experiences with stockbrokers or financial advisors.
Yeah.
And so they're looking for something that they can understand that's really simple to use. Um, I don't want to talk my book, but I'll give you an example. We recently launched an investment service where people can invest with us. And what we found was that even though people were coming to us to get help investing, about 80% of those people still had a financial advisor. And so they were using their financial advisor for something different, which was more like the tax planning, the structuring, their businesses, those types of things. Whereas when it comes to investing, they just want something really, really simple. And you don't have to go see a professional for this. Like anyone listening to this can go and buy an ETF. It's really easy. And I think it's democratized investing in a good way. And I think that when we fast forward to 2030, I think I believe what we'll likely see is we'll see about 80% of people's portfolios on average being invested via ETFs and the last 20% being in individual stocks and that type of a thing. So I don't think that's ever going to go away, but I just think the mix and how people do it is going to change because they're going to opt for the easier, diversified, low cost thing over time, even if they are a bit resistant to it now.
Yeah. Yeah, I guess it's I won't say it's counter to property investing because hey, look, you double down on a particular type of property or asset class, for example, whereas this kind of cuts across a number of different, say you talk industries or size of businesses, for example, and people go, do you go an inch wide, a mile deep with a particular type of stock or a particular type of industry, or do you go, the other way? And you're saying, look, I think the other way has its pros as well.
Yeah. You can do. And the thing is, I think like we often present people with false choices in finance. And like I own a property, I'm sitting in it right now.
Yeah.
And I also own shares and I also own ETFs and I also own private businesses. And believe it or not, I do have an NFT and I've got about $50 in Bitcoin and, all of these different things. And, it's I often joke, it's kind of like that taco ad where the young girl is saying, why not have both? Like, why not have both the hard and the soft shell? Like in finance, why not do it all? Like if you want to do it all, do it all. And I think that's what you can have. You can have a part of your portfolio that's like discrete for the stocks, or if you want to do crypto or you want to do this or that, you can go a mile deep in that one thing. But I would just say for most folks, they should quarantine it and know what each part of their wealth is doing for them. So how you strategically use your property, how you strategically use your shares, how you strategically use whatever else that you're doing in your life. And I think that's where you also learn the most, to be honest.
Yeah, spot on. Going back to your podcast, and I know the host that you've got, best in breed. So kudos to you for kind of pulling together some incredible talent there as well. But quite often when I'm working with clients, I'm like, you got the accountant, the financial planner, the buyer's agent, the broker, clients, maybe friends, family, parents, for example. And we're like, as you say, there's like 6 or 7 different opinions in the mix about how to say buy property or how to buy shares, or in this case, ETFs, for example. And it can be quite conflicting and also very confusing to the middle person who's effectively the client, the center of all this. How does someone come in here and, not that we want an echo chamber of advisors around them, but how do they then find the right team? Because my view is you only ever rise to the caliber of your team and the talent of your team. How do they go about assembling their dream team?
Yeah, I think that first of all, you got to know who's who in the zoo, right? Like you mentioned, all the different stakeholders there. And I think, I've got the Poor Charlie's Almanac book over my shoulder here. And one of the quotes that I loved of the late Charlie Munger was like, show me where I'm going to die and I won't go there. I think that like as we move forward as a society with things like AI and different tools and technology to solve a lot of our issues, like particularly the technical issues, the things that we couldn't understand in the past, we will be able to understand much more easily. So we'll be able to ask ChatGPT, hey, how does my car engine work? Right. And you'll get an answer straight away. Or, hey, can you help me create a website? Right. Things that people felt were too technical for them in the past. And I think what we're going to be left with as like individuals operating through society is we're going to have to double down on the soft skills and the more human side of like who we are and how we choose to invest our energy and our mental energy. And so I don't want to sound wishy-washy about this, but what I mean is if we combine those two things around, you know, Charlie's quote around just know their incentives. And so if you know someone's incentive, so for example, if you know that a financial advisor is probably going to charge you either a flat fee or they're going to charge you a percentage of assets, ask yourself why. And then ask yourself how that might impact the advice that you're getting. Or, for example, if your accountant recommends that you might be a good person to go into an SMSF, a self-managed super fund, ask yourself, is that just because it's a good option? Or is it because they might also earn fees from the administration and from the audits? And it might, in effect, keep me locked in a bit of a way. Not saying that SMSFs are bad, by the way. Like a lot of our community have them, and I'll probably open one in the next few years as well. But that's just an example. And I think the more you can understand how people behave and how they react under certain lines of questioning, I think the more discerning you'll be and the better team you'll get on your side. And I think if we think about finance and investing and the industry at large, I think for many decades, there's been a huge amount of agency and people that get in the way of a great outcome. And I don't mean that in a bad way. I just mean that a lot of the practices that were really common before the Royal Commission were really murky commissions, really murky deals, and just unusual things that would happen and layers of fees. And I think if you just ask the right questions, you'll get to know what people's incentives are and why they might be giving you certain types of advice. There's a wonderful website in Australia called MoneySmart, moneysmart.gov.au, and you can actually search for financial advisors and see which ones are licensed and also what they're licensed in and also their qualifications. Like I looked before we agreed to do this, I went and checked out your bio, right, on your website, and I saw that you have degrees and you've been ranked in the top 100 and all of these things, right? So I did my research before, we did this because it was really important to me that I know who I'm getting, into the studio with and chatting to. And I think the more you can do that, the better. But I think everyone needs a great mortgage broker. I think everyone needs a great accountant. I think people should be open to getting financial advice post Royal Commission because financial advisors, the good ones, the ones who are qualified and specialize, like in retirement or whatever the case may be, or for business owners, like they can be. You might pay them 5 or 10 grand, but they will be paying themselves off multiples just in probably the first year. So those are the three absolute essentials as far as I'm concerned: is a mortgage broker, an accountant, and a financial advisor. If you can attract really good talent there, your financial life is going to be many times better than it otherwise would be.
Nailed it. Thank you very much. Appreciate that. And that's one, I guess that's the success that you see that people set themselves up, good foundation, good team around them, drive them towards their destination as well. Flip it on its head and you go, there's investors that kind of started on the path and maybe fell off the wagon or made some bad decisions, and bad decisions often start with one bad decision that takes you off course, and you don't course correct at that point, and you drift so far off your destination as well. So what have you seen that consistently come up for investor errors that you go, just be wary if these is when you're kind of coming off track?
Yeah, it's a great point. I actually think that there's a great comment to be made here on just what you just said, which is that a lot of people think about, I guess, getting themselves into the right position to make good decisions, right? But one of the things that they fail to actually take notice of is the position that they might put themselves in. So a guy called Shane Parrish, who runs the Farnham Street blog, a wonderful thinker. We had him on our podcast not too long ago. But it's the podcast that I listen to the most out of all the podcasts in the world. It's the Knowledge Project. And in that, and in his most recent book, he talks about this idea of competitive positioning and being in a position to make good decisions. And I think that if we acknowledge a few things, like if we not acknowledge that we're not perfect, like human beings are not perfectly rational, I think this one thing that we've got to be mindful of is our downside in any situation. Like I think a lot of new investors, they put themselves in situations where there is an echo chamber, like they might jump on a forum, they might get advice from only people that agree with them. Like one of the things that social media, for all of its benefits, one of the, I guess, the cons of social media is that it does create an echo chamber because you click follow you follow people online that you like their content or you like what they have to say, right? Very few people that I've met actually follow people that they disagree with. And I think that that is a really rigorous thing to do in terms of the way you get your knowledge and how you learn is find people who disagree with you, but are also intelligent. So I actively follow people on social media who I would never, ever invest like they do. I would never, ever be oriented to their worldview. But I follow them because they at least challenge my perceptions. And if they're in my feed, then that helps me become a better person because I'm testing my ideas and the way I think. So that would be one thing is like a lot of new investors think that there's only upside and there's no downside, and there's always downside in investing. There's always downside. Another thing is that investing is truly a marathon and not a sprint. One of the things when I talk about ETFs, like if I talk about ETFs and this weird thing happens, I'm like, yeah, we're investing in the stock market and it's really diversified. It's kind of like lower risk than picking individual stocks and all that sort of stuff. They're like, that's not investing, as if you need to be more risk seeking to make money from investing. And that has always been a bamboozled me, but it kind of taps into the psyche of people think they need to do something drastic in order to get really good results. And that comes back from a bias that we have when we go to school and we get graded. We think if we work harder, we work smarter, we'll get better results. But most people in the stock market actually do worse than the stock market overall. It's a pretty well established fact. And I think one of the reasons that people get, I guess, wooed into picking individual stocks is they think, well, I got A's at school. I'm pretty smart. I'm pretty good. I can do it. I'll give it a crack. And fair enough. Like a lot of people are smart and some people can do it. But most people and 90% plus people won't do better than just the stock market average. It's just what the ETF gets. So I think a big bias that people have is like endowment bias is like, mine's bigger than yours, or like, I can do it. Someone else can't do it. There's a lot of things like that. And I could, we've probably filled 4 podcasts worth of ideas here, but I think that the biggest thing for new investors in the stock market to take away is just go into it ready to be, I guess, humbled, because the stock market goes up and down. 1 in every 5 years, it will fall dramatically. And most people can't predict that. In fact, I haven't met anyone who can. So just go in with your eyes open, know that there is some downside, and treat it as a marathon, not a sprint.
Awesome. Thank you very much. Yeah, it does. I often say that, investing will hold a mirror up, obviously, to your greatest fears and a lot of your insecurities as well. And it's like being in business. It does the exact same thing where it probably brings all that to the surface. And the people that can kind of face that and go, yeah, these are my weaknesses. This is my, I'm chasing ego and can almost address that will become better investors as opposed to the ones that are looking for the confirmation biases, for example, or the echo chamber around them. So, mate, thank you very much.
Well said. Yeah.
Another question I've got for you is, are you familiar? The answer is probably yes, but the 18.6-year property cycle, or the cycle in investing, for example, I've been doing a lot of research around these. Clients have come to me and saying 2026, 2027, since this year that we're going to see a huge correction, for example. I'm like, tell me more. And this conversation just unpacks it. I've got very curious. I've actually got Akhil Patel coming on the podcast very shortly as well to unpack this in his book. But take me through it. Have you come across this in your research and some of your work, and do you have an opinion on it at all?
I don't have an opinion on the necessarily the cycle as it relates to property, but as when I was studying the Chartered Financial Analyst designation, they did include a lot of things in there on different theories. And one of those is that like the US presidential election, depending on the year of the cycle of the presidential election, the stock market can be predicted. And so that's because of the spending cycles of the US presidential election. So some things are grounded in fundamental truth, but if it's simple pattern recognition, I think that most people should be very wary of just simple pattern recognition. Like if there are fundamental truths that drive the correlation, I think that's the important thing. There are some investors in the stock market who also believe in Fibonacci cycles and different numbers and patterns and these types of things. Once again, if they're grounded in reality, then sure. I don't really have a comment on the property one. I've done some loose reading, but not to the extent that I would have an opinion on a public podcast. You'd probably make me look like a fool because
Knock it
I would
on.
be talking out of my book here. But I would just say, like, one of the things that people should be aware of, no matter what happens, is, there's an old Peter Lynch quote. It's like, know what you own and why you own it. And um, you don't have to invest in everything or every theory or every strategy in the world. Like, I remember thinking this when I was younger and learning to invest. I thought, well, these other guys and these people down here have this really good strategy and it's worked really well. I should just do some of what they're doing. Or even in the early days of crypto, I saw some of my friends making a lot of money.
Mm.
And I thought to myself, I could do that or I could not do that and just stick to what I know and what I'm comfortable with. And that's played out okay for me. Um, and I would say that that's probably the best course of action for the most people because I've found that even people that do really well from things like we call it the humility curve. The longer you go through investing, you start off really low and you go up this humility curve where you get really confident, you take on more and more risk, and it seems to be right. The strategy seems to work, and then all of a sudden it falls to pieces, and you become humbled on the other side. And I think that the longer I've been doing this, the less and less risk I've taken. And it's not because my portfolio's got bigger, it's just because I'm more and more comfortable just living that way.
Yeah, isn't that so interesting? And that's one thing that really struck me when I was talking to, and you mentioned about a lot of your audience being like older, which surprises you. And I meet
Mm,
some older clients, and I'm like, you've got so much equity, and you have peak borrowing capacity. Kids left home. There's no private school fees.
yeah,
Home's nearly paid off. And I'm like, wow, you've got so much borrowing capacity. You've got heaps of equity. You can go and buy a plethora of properties, or invest in shares, or put in super. And you take the flip side to it, someone really young has very little borrowing capacity, very little cash or equity, but has balls of steel, and they want to take over the world versus the people that have the ability to go, I don't want to risk what it's taken me a very long time to build. And it
yeah.
would seem like a good idea to go and rush out and buy a number of properties, but like, just because I can doesn't mean I should.
Yeah, that's really, really interesting. I think it's that old line of you just try and be reasonable, not rational. I think
Mm.
if you let the spreadsheet rule your life, you probably have a great outcome, to be honest, if you as long as you know how to work around spreadsheets. But the reality is like there's a sleep at night test as well.
Mm.
I don't know if you know this, but I actually teach probably the most popular value investing program in Australia, and meaning that I teach people how to value businesses. And I do it for the Australian Shareholders Association. I do it for us. Done it everywhere, and it's been great. And I love that type of thing. Like I love buying individual businesses, like shares or companies. But 90% of my portfolio, 95% of it now, is in ETFs. So even though I teach the thing that everyone wants to know, what I'm most comfortable doing with my own money is using ETFs.
Mm.
And so just because you can do that doesn't mean you should do it. It doesn't mean that it's right for everyone. And I think that's a really important thing is that knowledge can also mean power because knowledge can also mean that you don't do the thing. It's easier to avoid stupidity than it is to seek brilliance.
That's
And
right.
I think if more people just stood within their lane, they would sleep better. And yeah, they might not get, the Pareto principle, they might not get 100% of the upside, but maybe they get 80%, and that's good enough.
I love it. I love it. As we kind of peel back the layers on some of the investor psychology, what are the other things that you're seeing? Whereas, I guess know your temperament, for example, know your limitations, be willing to, lose possibly some part of what you invest as well. What are some of the elements that you see as you come across? And again, knowing that you've got some older Australians and then some younger Australians that are very different stages in life.
Yeah, I think that probably what I've found is I think that like the hedonic treadmill is a very real thing. So I think that um, people who I guess think that they're going to be happy like they'll think that they're going to be happy when they get to more money, or they think that they'll be happy when they get the new job, or they'll think that they'll be happy when. I think one of the great things in life is that you can have your North Star and where you want to be in life. And a lot of people just struggle to even come up with that. So we get on this corporate treadmill and whatever. But I think that one of the things that I see a lot of is people taking excess risk for something that is not really going to make them happy anyway. I'm very blessed in that I get to speak to some families and individuals like founders and that sort of stuff who are extremely wealthy, financially speaking. But in the rest of their life, they're not wealthy. And I think that people take excess risk, both in terms of too much time committed to their job, too much time committed to finding an investment strategy that's going to be like perfect when they're almost unattainable, too much time spent, looking at a computer screen and a brokerage account when they're not going to get that much benefit from it. I think it's not so much a bias, but it's definitely something that I see a lot of. And I think now more than ever, there's an opportunity for people to invest pretty simply, pretty low cost, have your property allocation and use ETFs for basically everything else. And you can put your life on autopilot. Like most of the people that listen to the show will know a lot about property, thanks to you and all of your guests. They'll know a lot about property. And so if that's where your skill set is, and if that's where your passion is, put more time into that. Because I think that, there are a few ingredients you need. You need curiosity, you need the time, and you need like the risk appetite for whatever you do. And a lot of people don't have the time to become a master at stock market investing. A lot of people don't have the curiosity, and a lot of people don't want to get back on the bike after it's fallen 30%. So unless you have those ingredients, like just choose your battles and pick your battles wisely. I would say I'd see in my younger community, particularly with the men, sorry fellas, that the temperament isn't always there. And this is not just necessarily with stocks, it's also I see it really pronounced in cryptocurrencies and Bitcoin and these types of things. People become fanatical about what they own. And I used to think to myself that the stock doesn't owe you anything, meaning that just because you think it should be higher doesn't mean it will go higher. Because the world has this kind of like self-correcting tendency where you don't have any impact on whether the stock or the Bitcoin price goes up today or not. And to be honest, really no one does. And so the only thing that typically sends them up or down is gravity. And the gravity comes from the fundamentals that are driving that business in the case of the stock. And so that's what you should be focusing on. And I'll give you one more bias that's pretty common, which is recency bias. People think that because something has done well recently, it will continue to do well. And that could be, when I say the term recently, there's also a bias around that, is that recently probably means like a couple of decades. It doesn't necessarily mean because the US stock market has Netflix and Amazon and all those types of things that it's going to have them in the next 20 years. Maybe they come from China. Maybe they come from India. Just because the Australian stock market has paid a lot of dividends historically, it doesn't necessarily mean it's going to happen in the future. Maybe there's laws change around franking credit. And so, just because super is probably the best place for most people approaching retirement to put their money now doesn't mean it's going to happen in the future. And I think like recency bias is a really important thing because just understanding it and being aware of it means that instead of trying to predict what's happened in the past and extrapolate that out into the future, what you will probably do is you will build your wealth so that it can't break. So what I mean by that is like, don't plan for a certain future, plan for any future. And it's kind of like, yeah, property's done really well. Aussie stocks have done really well. But that might not always be the number one asset class. So if you believe that, you might actually diversify through, you might start a business, you might invest in Chinese stocks a little bit, not all of it, but maybe a little bit, because you think the Chinese economy is growing really fast or something like this. And I think that's where that humility piece comes in, Aaron. It's like people who have these biases, the best thing they could probably do is diversify and just admit that they don't necessarily have a crystal ball. And so to just build wealth overall. And I know that's a bit wishy-washy, but what I would say is just build as many assets in as many columns as you possibly can.
I love it. I love it. I want to say thank you very much. There's an element to you where you've got such a great authority. Obviously, you've got your media side, you've got your education side as well. But on a personal note, you've also got this, I feel like this calmness and this level of curiosity still. You may know a lot, but you still feel like I don't know everything. And
I think the
I
more
think
you
there's
know, the less you know, right?
there's a great sense of humility that starts to come through, mate. So I want to say thank you so much for sharing on here as well. I know you're a busy man. I know you got a lot of things juggling at the moment, but I want to say thank you so much for your time, sharing your knowledge and insights, man. A real kudos to you and what the team are building there at Rask. I love it because we're telling our clients, if you want just to cherry pick a few ideas and go onto your site, and there's just some short videos, there's some short courses where you self-select, you opt in, and the stats are damning when it comes to course completions online, particularly if it's free. People don't value it, for example, but there's some real gold nuggets in there. So if anyone's listening, just be curious to jump on there. Just find out a couple of short courses, for example. Do yourself a favor and invest your own time into your own personal and financial well-being. So, mate, thank you very much.
No, thank you, mate. I really did appreciate when you and the team reached out. You've got a great team around you, and you ask great questions. You do wonderful prep. As a fellow podcaster, I know how much time goes into these things, and you're excellent at it. And I wish you all the best in the future,
I appreciate it. And I think you and I do it because when people give up their time to listen to our podcast, that means we have to reward that time with making sure that we not just talk rubbish for a little while. It's going, we want to actually give you some real gold that you can take away, and this time has been a well-worthy investment into your future. So that happens two ways, mate. So respect is mutual. Thank you so much.
Thanks, mate. I really appreciate it.
Appreciate it. If you've loved this episode, we don't, like I said, we're not chasing reviews, we're not chasing subscriptions here or likes. What we're chasing is people to share this message. So if you think you love this episode and you know someone that wants to check it out, share it with them. And like I said, this ripple effect starts to get bigger when people in the community are sharing what they're learning and inspiring other people to come on the journey with them. Owen, thank you very much. We'll include details to Rask, to Owen. Check him out, for example, and his team and what they're putting out there. We'll talk to you soon. Thanks.